When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon. First off, welcome. I have a feeling that you're going to either leave this session that we have and say to yourself, whoa, that makes a lot of sense. Like, a lot of that stuff is clicking, and you're going to start to become a little bit of a, um, an addict. You're going to start going through millions and millions of charts, which to me I think is a good thing. I think that level of practice is only going to expedite the process. Or you could be in the other part of this where you see it and you say, there's no way I'm ever going to get to this point. I'm done with this shit. I'm quitting, right? And I will say that it doesn't happen all that much, but if you do feel yourself kind of feeling a little overwhelmed, that is okay. With time, it's all going to come together. Tonight, we're just doing really basic brush strokes on some of the key concepts. I know I spoke to a few of you. You've already, watched some of the videos that I had made on them where they get much more in depth. To me, this is step one. This is really just entry level. Like, you're going to hear me say these words, at least kind of have somewhat of an idea as to what it is. There is a very regimented process here, and the beauty of it is each specific model that we're going to talk about, because realistically we have about four. You don't need to use all of them. You don't need to use any of them for that matter. You might find something in what I'm showing you here that resonates well with you and something that you can build off of and create your own thing, right? You really don't have to use any of mine, right? I know a lot of people in here do use the Mando model and the London kill zone specifically. A few use the odd NAM, which is, we'll get to it, but just basically the inverse of our Mando model as it is. And then last but not least, it's kind of the ICT unicorn. So it all comes together there. You guys can all hear me now. Eva, you good? Let's see. I just saw those messages. Yeah, I just want to make sure you guys can all hear, and then we'll get into it. Let me just make sure he's good before we roll on here. But like I said, everything can really be segmented into whichever one of these concepts that really click with you, and you can kind of create your own thing. And now the beauty of this is whenever you do ultimately create your own model, it's not some, pardon me, not your bullshit moving averages that are going to change all the time. It's not something that you can't go back in time and back test. This is something that you will be able to back test every aspect of said model in order to create something that, one, you can prove is prove success with, but in addition to that, it's something that you will have a lot of confidence in, and when you have confidence in something, odds are it's probably going to work out much better for you when you actually trust it, right? Because to me, there's three stages to this, and it's first, you kind of have to have a basic understanding of the concepts. This, I don't think, is going to take all of that long. I think by the end of tonight, you guys will, and this is only really going to be an hour. It's nothing too crazy. But by the end of it, I just, a little bit of familiarity with it will definitely go a long way, because the next step really is to be able to start to see it. You start to see how price reacts to certain, whether it's an imbalance, whether it's an order block, whether it's a breaker. You see in certain market structures which imbalances would be more preferable in that situation. You look and see how price reacts to liquidity. Once you start to see those things in hindsight, that's a very good sign, because ultimately you're not going to be able to anticipate price and see it before it happens if you can't do it in the past, right? So again, it's brick by brick. It's a stepping stone. You don't want to rush too much into this. Get the concepts down. I'm going to show you, and hopefully by the end of tonight, you're going to say, oh, wow, I see how this works, right? That's the goal. And if that works for you, slowly but surely, with more practice, it's all going to come together. We've had hundreds and hundreds of success stories throughout time in here. With we have over 100 past demo accounts for funded trading where you now are, you don't have to risk your own capital to trade anymore. 100 people have gotten that, right, to this point. How many have kept it? We'll find that out shortly. But that's in itself a stepping stone to prove to you that what you are doing is working. How can you be more efficient so that you don't lose that account, right? Or even if you're trading options, right? Same type of situation. How can you get your model to a point where you are consistently making money and not giving it back immediately, right? That's the goal. So, to build off of those three, first you got to kind of have an understanding, then you see it, and then you can anticipate it. Those are really the 3 steps. And overall, you're going to hear me talk about 3 main concepts that ultimately come together to create my trading model, the Mando model. Okay. The first being imbalances, second being liquidity, and third being market structure. Right? All combined, that's where you get the Mando model. Okay. So let's just go back in time a little bit and we'll take a look. And first off, I'll start with imbalances. This is very important because the imbalance itself creates really the entire makeup or trade plan associated with whatever we're looking at, right? Without the imbalance, for me, there's no entry, right? Without the imbalance, I don't know where I should be placing my stop loss so that I do not get smacked if it goes against me, right? Really, without the imbalance, there's no trade for me, right? And there's certain situations and certain times throughout the day where you're going to notice, oh, okay, I can see it setting up. It's coming down to that imbalance. It's not quite there. I need to wait, right? So it's even giving you that, like, I guess that little bit of a compass in terms of like, okay, I need to wait. There's nothing here for me, right? And to me, defining that prior to anything is very, very important. So we'll use this previous example on NASDAQ, as the basis for our idea here. But we'll draw our range. We'll get to that in a second. But the idea behind the imbalance is it is a specific region on the chart, okay, where you have an imbalance in price in one direction while there's an inefficiency in the other direction. What do I mean by direction? Whether it's up buy side or down sell side. Okay, so when we see, and this is simply put what it looks like, and again, you'll probably be able to do this in 10 minutes, right? You were to look at a specific candle, okay, any of these candles, and what you notice is that on either side of this candle right here, there are no wicks on either side of this up close candle, right? From this point here to this point here. That is an imbalance. There is an imbalance in price in that specific region. Why? Right? So, to use terms that I don't, really completely buy into these ideas, but there's, an abundance of buyers and a lack of sellers in this specific region. There weren't even enough to get up into this specific region on the chart. And this range is from 381 to 144. Okay. Now, the way that we look at this is inside this area, right? Think of a teeter-totter or a seesaw right at the park. You sit on one side of it, naturally the other side's up in the air, okay? Now, every time price gets back into that imbalance, it's like throwing a sandbag on the other side. So over time, that area is going to be balanced. But one sandbag of 40 pounds and you're sitting on the other side 180 pounds, that's not balancing that range. So what we would anticipate is that when price hits that imbalance, right, we are going to hit it and take off. We don't really want to sit around in there too long. We want to get in and get out as soon as possible. Okay. So again, wick, body, wick. Okay. One more time. Wick, body, wick. Okay. Price gets into our imbalance. Price gets out of our imbalance. Okay. This is literally exactly what we want to see, right? We want to see price get in and price get out. Now, with that being said, that's a bullish imbalance. I'll show you what the bearish imbalance looks like very similarly. Here it is. So ready? Wick, body, wick. Okay, no wicks on either side. We would anticipate that when price gets into this imbalance, that price is going to get in and get out. Okay, here it is, ever so slightly. Let's zoom in here and look at this. Price gets in, price gets out. Okay, that's exactly the most ideal situation we have there. Now the beauty of this is, obviously, with more time you'll buy into it, right? But I can tell you, and if you take my word for it, this works. Price gets in and price gets out. There's a few little things that we'll get into as to, what imbalance is more likely to be successful versus lower probability. We'll get to that in a second. But the beauty of these imbalances are that when you have one mapped out and there's one that's, specifically catching your eye, not only do you have your entry mapped out, right? Ideally, you want a long in a bullish imbalance, right? You want a short inside a bearish imbalance, okay? But prior to the trade, everything can be mapped out here for you. Here's what I mean by that. You have your entry at some point inside of this imbalance. You can even say to yourself, I want to see us leave the imbalance before I enter. That's fine. If you're anticipating price to go up from that point, what's the problem with letting it show you get out of it? That's fine. It might be a little late. You might lose out on a couple of points, but that's okay ultimately, right? As long as price is going where it's going and your entry is not, let's say, for example, up in this vicinity, right? We'll get to that in a second when we map ranges. But also, you have your stop loss just in case you're wrong. The low of the candle that creates that imbalance is always my stop loss on trades. Why? If I'm using this imbalance as a way for me to structure an idea, ultimately, if that low of the candle, if that candle is taken out, what is that telling me? That price inside this region is now balanced. And my idea to buy the imbalance in price, it's no longer valid. If price is balanced, then why am I still hanging on to a trade that's, it's balanced at this point. The price range is balanced. Price can move freely within that zone now because that candle has been voided, right? So it gives me a very sweet criteria as to where entry, exit, and even my take profit. That's going to be when we fall into the liquidity part of things, which we will get to. But simply put, you can go into the idea and say, okay, I want to buy this imbalance. My entry somewhere in the 10,845 range with a stop loss down here at 10.76. If that's too big for you, like there could be a situation where you have a pretty big range and it might not be something that you want to really, potentially be wrong on, right? Let's say it's $10, right? If you're looking at something like SPY, or maybe it's a $10 candle. That's too big for me. You don't need to trade it, right? It's all mapped out there for you. If that's something that makes sense, fantastic. If you're trading futures, you know exactly how much money you could potentially lose in that situation. 20 points for each point times however many points. That's your potential loss. And then multiply it to where you think price is going to go times 20. There you go. You have your whole trade mapped out before you, right? So there's no more, oh shit, that loss was way bigger than I thought it was going to be, right? There's none of that. You don't have to worry about that anymore because it is all mapped out for you well in advance. And if it's too big, if it's too big of a risk, you could potentially lose more money than you would have liked to lose, then you don't have to take the trade, right? Go somewhere else. There's tons of names that you can look towards, right? Now with options, it's not going to be as simple, right? Because options, you have to deal with a couple other things, such as delta, gamma, theta, you name it. There's Greeks associated with those specific contracts that do influence the amount of money that you can make or lose in a certain situation, right? And if you don't really know all of those that well, that's fine. Just drop something in the comments right now. I'll take a look and I'll explain that a little bit more. But options contracts are a little bit different than what it would be like trading underlying stocks or futures, right? Where it's just cut and dry. I buy at 10, I sell at 11, I make $1 per. It's not necessarily the case with an options contract. You're dealing with a lot of other external factors, which we call the Greeks. But even still, right? Your delta is the probability that ultimately that contract ends up in the money, right? And if that's the case, where you're looking to see, okay, well, my delta is 60. That means and you'll see it on any options contract you ever buy. It's going to show you the delta, the gamma, the vega, and your theta, right? Every single one, it's going to show it. What the delta is telling you is if you have a 60 delta, that means for every $1 move that you have, $1 up, you're going to gain $60 per contract. If it goes down $1, you're going to lose $60 per contract. So you can essentially do the math on, let's say, for this, let's say it was a $4 loss and your delta is 60. 4 times 60 being 240. I know the max that I can lose in this is going to be $240. Plus you got to add in a little theta. We'll get to that later. But that's what you could potentially lose. So when I hear people, oh, I got in and it knifed on me and I got stuck in it, and that, to me, that's a lame excuse. You can have this whole thing mapped out prior. If it voids your plan, then why are you still trading it, right? You need to kind of become regimented in a way where you don't even think twice about it. If it takes out the low of the candle that created your imbalance, you were wrong. And if you can't become good at accepting being wrong, then this might not be the right business for you, because this is something where no matter what, you're going to be wrong. I don't care if you're the best trader in the world, you're going to lose, right? It's just a part of things. And honestly, the more and more that you look to press buttons, the higher the probability you're going to run into a couple losses are. But are you going to allow yourself to lose 10 winning trades of progress in one trade because you don't know how to pull the stop loss? You don't know how to take that loss. We've had it here, actually. We've had people who have gone on insane runs and they've totally blew it on a week of bad trades and not respecting a stop loss, right? Because you're all going to get to the point where you feel very confident that you can kind of identify where price is likely to go. It always comes down to that execution. And with time, your execution is only going to get better and better. But at first, you really have to start to embed it in your brain that this trade was mapped out prior. If I'm not following my plan, whose fault is this, right? A lot of it comes back to you, and a lot of people can't handle that. So that's why I'm just being very, candid about this and straightforward, because like I said, using these methods, you will have a trade mapped out for you. Are they always going to be correct? Probably not. More often than not, I think you'll be right, but probably not. And if that's the case, can you take losses? If you can't take losses, you're going to be in some trouble, because those losses that you don't take turn into massive losses when you don't know when to pull the trigger on something, right? So the risk management part of it, and you're going to hear me talk about this a lot over the next month, but I don't buy the trading psychology. I think it's important, but I think that it's secondary to actually having an understanding of how price works and how the market actually moves. If you don't have that, then of course you're not going to know, you're going to be sweating trades, right? Your psychology is going to be all fucked up because you don't have a specific game plan in play, right? You just haven't done it enough. Of course you're going to be sweating. You don't have confidence in it. You haven't built up that confidence in yourself to actually trust and respect the trade plan that you have mapped out for you, right? So that just all little secondary stuff that comes into play when this is just trading in general. But let's see. Yes. So the next concept, and also if you have any questions about uh, imbalances at all, put them in the chat right now, and we'll hammer it home. These are very important, just how to map them. Okay. And you're going to hear, I tend to use the universal term imbalances, but there are two forms of imbalances that kind of fit into that one folder for me. And the first being the fair value gap, which I showed you guys here, right? A fair value gap, right? We have a buy side imbalance and an inefficiency to the sell side. And up here we have a sell side imbalance, buy side inefficiency, right? Buyers are inefficient in this area, creating that imbalance in price, ultimately pushing price lower, okay? But the second form is something that I'm sure all of you who've been around for a little bit have seen or heard of before, and that's simply just a gap, right? If you have a gap higher, we call that a bullish volume imbalance, right? A gap lower, a bearish volume imbalance, right? Just gaps, but those gaps, they actually carry a lot more weight than what you might have thought. When you see a gap on the chart, a lot of the times they can kind of indicate the market's next move, right? If you're seeing a gap down up in premium of a range, we're going to get to the premium and discount, don't worry. But if you see one in premium, that's going to show you some urgency to move lower. If you see a gap up in discount of a range, oftentimes that's going to show you some urgency to get up and get going. All right. Just all little things that you can add in as well. I just heard the Discord beep. I want to make sure. Okay, good. Yeah, no, I'm glad a lot of people who've been here for a while coming in just for a little refresher. But so that's first, imbalances. So nobody commented, so I'm guessing you guys got it. All right. Of course, if you have questions, feel free. But that'll be kind of step one. Now, step two, we'll go back up to liquidity, right? So this is arguably the most important concept that we're going to talk about. And this is ultimately, to me, where price movement stems from. And liquidity, just another word that you can use to associate with, would be money, right? Liquidity. The algorithm, which I hope that you all buy into by now, and if you're new here, I hope you will buy into it pretty shortly. But and again, not just from me saying it, but from seeing it for yourself, that this algorithm that delivers price is driven by money or liquidity, right? Now, ultimately, the whole idea here is for that algorithm to go chase liquidity. It's going to go to a liquidity target. And, you might be thinking, where the hell am I going to find that? To be honest, it's really not the most difficult thing, really. We're looking at key swing highs and swing lows, okay, as pools of liquidity, areas in which the market could likely go to, okay? Now, there's ultimately, and this is really the secret sauce behind trading, in my opinion, I think this is probably the biggest game changer for anybody, really. You can have a bozo using moving averages and trend lines, but if he has an understanding of the concept of liquidity, I think he'll probably do all right. But if we can get an idea as to where price is going based on our pools of liquidity, right, which you can, and I'll explain that next, that's market structure. But if you can get an idea of where price is going, that doesn't necessarily mean I need to buy this and hold it until we get up to buy side liquidity, right? Because there's a few red candles mixed in. You might want to take some profits. But if you're on the right side of this thing for the entirety of this range from discount to liquidity, buy side liquidity, which would be a swing high, sell side liquidity being a swing low, that's a lot of points that you're going to be on the right side of things for, right? This in itself is, 6,000 points. Do the math. 6,000 points times $20 per point. So that could be a lot of money. And again, you don't have to catch every single one of those points, but if you can catch a majority or a nice chunk of those, it's a pretty good feeling. That's a good amount of money that you can make, right? Now, how do we know which pool of liquidity the market is going to target? Is there a way for us to feel really good about it, right? And if you're here, you've probably seen me post stuff on Twitter, and when I post stuff on Twitter, the only way I'm posting on Twitter is if I feel really good about it happening, right? I don't want to be throwing out losers left and right, right? So, that component of it has actually helped me become better, because now if it's not clear as day, or I feel like it's clear as day, I'm not going to post it, because I don't want to have a bunch of clunkers and for idiots to attack me all over the place, right? Unless it's really high quality, I'm not really going to put it out there. But how do we identify which pool of liquidity we're likely to target? Well, we have something called market structure, or our trend, right? You've probably heard that word before. But how do we identify a trend, right? I'm not talking about using that line that people just do this and they try and use it to fit their narrative. That's the best, right? They just try and maneuver these like triangles all over the place to make it make sense, when it's just a load of shit. There's nothing to it, really. But how do we know in a way that we can backtest and prove it that this is something that actually works? Okay. So ultimately, all that we're looking for, and I'm going to use, we can go back to, let's do it on the weekly, actually. This way there's a little bit more humps and lows on on a weekly time frame versus a monthly, which is really kind of pure, and price movement is pretty smooth. But let's take a look, okay? So I think it's fair at this point to say that, let's go back here, whoops. We took out this high, right? And this goes for any high or low. We can do this anywhere. I know we're going back to 2018, but I just want to show you the repetition over the last couple years. It's fair to say that we took out this high with what price run? Okay. From our this low, swing low, to swing high. Fair? I would say that's a fair assessment, right? So we're looking for highs and lows to be taken out. If we take out a high, we are looking at a bullish trend. If we take out a swing low, we are looking at a bearish trend. And we're always going to be pivoting towards the higher time frame. The higher time frame, the stronger the setup is going to be, right? So if we have what would have been technically a bearish structure on a daily time frame, but our weekly, that's getting us down into discount, I'm going to pivot towards my higher time frame. My higher time frame is going to know all. We had this, something similar to this happen a couple months ago, where we had a weekly imbalance, bearish imbalance form on Nasdaq. But then you look into the monthly time frame and you see that weekly imbalance literally just brought us into a monthly bullish imbalance, and we took flight from there, right? So I'm always deferring to what I see on a higher time frame. And how we analyze this and really come to conclusions is something that I think it's going to be beyond one night. I don't want to overload anybody, but at this point, my model, the Mando model, where it all comes together using the ideas of imbalances, liquidity, and market structure, is as follows. After we take out a swing high or swing low, I'm going to map the range that does so. Okay, so this is the price run that took out that high, correct? Okay. Now from this point, you're going to notice that price does not hit this 50%. What that tells me is our range is not set. Why? Our range won't set until we get an opportunity at equilibrium or fair value for whatever the asset is. Okay, if we do not get to that 50%, there's really no interest to me, because to me, fair value of a range, or of whatever we're talking about, Nasdaq in this instance, is right in the middle of our high and our low. That is equilibrium, right down the pipe. Now, from this point, the way that I look at this specific range is anything above 50% is premium. I am overpaying for it above 50%. If it's below 50% in a bullish range, this is discounted, right? It is below fair value or equilibrium, right? So let's just pretend this is milk, and milk is $5, okay? $5, or generally $5. That's equilibrium. That's the midpoint value. Now, if you go to a place and you see, $7 for milk, you're probably, if it's a necessity and you need it, you might have to overpay for it, and that sucks, because you could have went down the street and got it for $2 less, right? But if you see something that's discounted or on sale, you're probably more likely to buy that because it's discounted from its original value, its fair value. So if I don't get 50% on a retracement like so, all that tells me is that the range is not set, okay? So from this point, you're going to look again, and you're going to notice that, again, we didn't get discount. Damn, man, I'm missing out on all this opportunity. Just wait. Here we go. Right up to the high prior to COVID, okay? So you guys probably all know about the COVID crash, right? Quote unquote crash, that's what I call it. What is the COVID crash to me? Well, to me, this just looks like a discount retracement into, we have a couple, hold on, right here. There's one, and here's your second. This is what we would refer to as an inverse. Okay, ready? Discount retracement into a bullish imbalance. Hold on, where's this red one? Come on, give it to me. There it is. Prior to your run for highs, okay? So, Mando, you were just talking to me about which pool of liquidity that we can target, what was that all about? When you have a bullish trend, when you've taken out a high and you've seen 50% of a specific price range, go back and backtest this. Tell me how many times price gets into a discount bullish imbalance and takes off for buy side liquidity. Just go check in the Manda model folder. You guys are all in the group. There's a zillion examples. This is the market. This is how price action works. Look, just because it's what I use, don't don't take it out of context. Do it yourself, and you're gonna start to see, holy shit. Okay, got it. Now watch this. After you get your discount retracement into a bullish imbalance for your run to highs to complete my model, what is one thing that is noteworthy inside the entirety of this? And, this is a broad question, so I'll give you the answer. If we're entering down here in discount, what's really our risk in this trade? Way less than 50% of our range to make way more than 50% of our range. If we're buying 79, right, it's lining up with 79%. We're not using Fibonacci. It's all just for measurement. But if we have an imbalance that down here, this is probably like 81, 82. We're scoring 82% of the range while only risking 18. Does that make sense to you? That makes sense to me. My reward is always way more than what my risk is going to be. And this is why this model, when I first got it put together and started to make sense of it, why it makes sense to me is because this is something that happens over and over and over again. And on top of that, if my reward is always going to outweigh my risk by a lot, that makes me feel pretty good, right? That makes me feel okay. I can stop out 2 or 3 times. If I hit once, guess what? I erase those stop outs and still make money. That's the goal here, to really, and you might hear some people say, oh, the risk reward doesn't make sense if you know where price is going. Sure, but guess what? When people are just starting to learn how to do this, to have a better risk, have a better reward for your risk, to me makes a whole lot of sense, right? So as we continue, we're almost done, I promise. Here's your low. Okay, what was the price run that took out our previous swing high pool of liquidity? Right here, and you see I have it labeled. What was that price run? Go through go to every single red candle or black candle. Ask yourself, do we see 50%? No. Okay, that's fine. Range is not set. Go to each red candle. Do we see 50%? Nope, we don't. What is that telling me? The range is not set. The range is not set. The range is not set. Aha! Got it. Low to our high. We now have an established range. This is something that I'll teach you guys after. I don't want to overload you, but when you see the first bearish imbalance happen, oftentimes that's telling you discount is coming. Okay? But from this point, you have a bullish trend. I think that's fair for everybody to say. We took out this high with that price run. Okay? We are now in discount of that bullish range. Okay? So with that, what can we look for? We can look for some sort of imbalance to be taking place in here. And I might just add that with where we currently sit on these NASDAQ contracts, they are adjusted over time, 3 or 4 times a year. Okay, so these levels might not be absolutely precise, but if you were to type in at Mando Trading within, I don't know, October 2022 in that tweet, you're going to see that we're going to have some sort of imbalance lining up. In this case, we have something called an order block, and this is for another time. But this is another form of an imbalance. It's for another time. Don't worry about this. You really don't even need to know about order blocks if you don't want to. But price gets down into this bullish imbalance down here in discount of your overarching bullish trend or bullish range. Okay. Now, from this point, which pool of liquidity is more likely to happen? You can just refer back to, is our trend bullish or is our trend bearish? If our trend is bullish, where are we looking? Upper highs. Remember that bear market of 2022? Yeah, I just call it a discount retracement into a bullish imbalance. That's all. All it is. Just took a little bit more time than COVID did, but guess what? Same result. Price just gravitates towards discount, specifically an imbalance, ultimately running for our buy side liquidity target, which is our previous swing high. That's all it is, folks. Ready? I got another one for you. Okay. So, following our first shift in structure here. Okay. You guys remember that bank crisis that we had with Silicon Valley and all of that nonsense, right? You guys remember that? Well, what happened after taking out this high? What's our range that we can map out? From our low to our high. Fair? We took out this high with that price run. Okay? What do you notice here? What's in discount of this bullish range, right? When the bank started to blow up. No, we're just getting into discount bullish imbalance. Do you see why I don't give a shit about news? It doesn't matter to me whatsoever. Price is algorithmically delivered in a way in which it's something that is repeatable regardless of the news. I don't care. I'll go to any chart. I'll go to Tesla. I'll go to Apple. I'll go to Boeing from 1970. It doesn't matter. I don't have the earnings reports from back then. I don't know if they had wings flying, blowing off the planes back then too, right? I don't know any of that shit. But price delivers this way since the beginning of time. We can go back to Boeing if you guys want to do that. I have a whole video of that. Going back to Boeing, we did FedEx, or maybe it was UPS. I forget one of those. Going back 40 years. These concepts still work. All right. Now here's your low to your high. Here's your discount, bullish imbalance. So right when we hit 50%, what is the more likely draw on liquidity? You're going to hear us all talking about that in this group. Draw on liquidity. That is the target, basically. Where do we think price is likely to go? Well, we have a bullish trend. We got our discount retracement. We got into a bullish imbalance. Ultimately, we're looking for highs here, right? We're looking for a continuation. And there it is. Bingo. Run for highs, okay? Now the same thing applies. We took out this high with what price run? From your low to your high. No discount retracement. That's okay. What is that telling us? The range isn't set. Don't worry. We'll get an opportunity. I feel good about that. Okay? From your low to your high. Here is your discount retracement. Do we have a bullish imbalance? Sure do. There's your run for highs, right? Once we get to 50% and this range is set, where's price likely to go to? Our buy side draw or our sell side draw? Are we bullish or are we bearish? Well, we're bullish. We took out this high here with that price run. We're looking for this high. Guess what? Low, up and through. Mando model is complete. Okay? Now, how about this one? What we're about to complete here, and I fully anticipate this happening over the next couple, hopefully sooner, but probably over the next couple of weeks. What was the price run that took out this high right here? From your low, your previous discount retracement into a bullish imbalance, to your, go to each red candle, you're going to notice that our range was not set. Even after here, our range wasn't set, right? 50% we need. That's okay. Discount retracement below 50%, check. Bullish imbalance, check. Let me remove this. It's a previous bearish imbalance. We'll get to that another time also. Price gets into discount, bullish imbalance. We sweep liquidity. Is this our range setter? Nope. Low to high. Here's your discount retracement. We sweep liquidity, gather money. This is something called turtle soup. Again, for another time, I don't want to throw too much at you, but this is a layup. Run for highs. That's the expectation. And that's going to complete the Mando model yet again. And that's it. That is the Mando model. Imbalances, identifying liquidity, understanding current market structure, That's really it. That's my model right there in a nutshell. Now, oh, you're just showing me NASDAQ. What do you want to look at? We'll look at anything. You want to look at Apple? Sure, we can look at Apple. Do you want to look at Tesla? Go ahead. Let's go. Go through 100 names. Don't matter. Ready? We'll see an immediate one right here. Low to your high. Discount retracement, 50%. Bullish imbalance, right here. Run for, oh, not yet. It's coming. Ready? Here's another one. Low to your high. We took out this high right here with that price run. We didn't get discount. That's fine. Did we get it over here? Not quite. Okay. Big range. Wait, one more time. Whoops. There it is. Okay. There she blows. There she goes. Next. What's the next one you guys want to look at? We'll look at Microsoft. We'll go through all of them. Don't matter. Ready? Same situation here. From your low to your high. Here's your discount retracement into a bullish imbalance. There's your run for highs. Mando model complete. Why are we targeting this high? Our trend is bullish. We got into a discount bullish imbalance. Buy side, here we come. Okay, next up. Low to your, whoops. Go through each red candle. Let's see if we get discounted. Nope. Okay, that's fine. Let's see. Did we hit it there? No. Nope. 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 No discount retracements. That's okay. We can look towards our daily range. That's what I currently have mapped. All right. If we go to the daily, it's going to be much more clear. Ready? So if you're not in discount on a monthly time frame, that's okay. You can look at something like Meta. That takes 11 years to complete a discount retracement on a monthly time frame. But go over to your daily time frame. Clear as day. From your low, whoops, to your high. Here's your discount retracement. Here's your bullish imbalance. Here's your turtle soup. That's just an added layer. You don't need it, but there it is. So far, so good. Where's our buy side target for Microsoft? 468.35. Right? Let's go to Netflix. Okay. Where are we? Go through each one of these little price fluctuations. Okay. And you can go through every time we've taken out a high. What happens? Okay. We took out this high with what price run? Low to high. Bullish imbalance. Run for highs. Mando model complete. We took out this high right here with what price run? Low to high. Discount retracement. Bullish imbalance. Run for highs. Mando model complete. Low to your high. Discount retracement. Bullish imbalance. That's a gap up. Volume imbalance, right? We talked about that. Run for highs. Mando model complete. Low to your high. Discount retracement. Bullish imbalance. Run for highs. What's next? Go on forever. Low. This is what we're currently working with on our range on the weekly. Any more? We can go through any. Does it work on crypto? Sure. Low, high, discount retracement, bullish imbalance, run for highs. Low, high, discount retracement, bullish imbalance, run for highs. Low, high, whoops, discount retracement, bullish imbalance, run for highs. You're starting to see it. Come on, tell me you're starting to see it. Nice. Great. Integrity, I knew you were newer here, so I want to make sure of that. What do you think, guys? What do you think? And what do you think, Ibra? What do you think, Flow Hunter? What do you think, Greg? And the rest of you guys have been here. Joe, what about you? What are you guys thinking? Repeatable. You sure you want to see it on GME? I don't want to show it, but I will. Fuck. What do you see? What was the price run to take out all of these all-time highs previously? Low to your high. Look what we got on GME right now, folks. One big Mando model. Deep discount, bullish imbalance. Low, high, discount retracement. It's a matter of time, unfortunately. That's all it is. That's a great question. Let me read out the rest of the comments, and Gash, I'll get to yours. That's a great question. See, it seems like an easy way to trade. Yep, the way, ultimately, it's something that maps out the entirety of your trade. Therefore, if you are wrong, you're stopping out for minimal losses. If it's not going to be a minimal loss, then why are you taking the trade? It's too big for you. You know that before you even enter the trade. Why would you take it if you think it's too big for you, right? That's the beauty of it. You have an idea of where the target is. It's going to completely outweigh the potential loss that you're going to take. And if it doesn't, then why are you taking the trade? It's mapped out before. You know what it could possibly be before the trade. There's no getting caught with your pants down in this. It's always mapped out. Beautiful with this simplicity. No favorite indicators, no mess of a chart. Starting to better understand the price delivery helps you really establish a plan. Yep, absolutely. You don't need any indicators. Anybody who tells you that you do, they're full of shit. It's to me, that is much more distracting than anything else. The news, what you see on CNBC, what you see from 99% of these idiots on Twitter, it's all bullshit. You don't need any of it. If you learn how to read price and you can see that this is something that is extremely repeatable, and remember, we have 4 of these. This is just one. This is something that you can feast off of, and that's all it takes. One setup. You don't need to trade the same exact thing. You don't need to, stress yourself out. If it's not there, you're going to finally believe that, okay, I don't need to trade because I know the next time I get it, I'm going to hammer it and I'm going to set myself up for a couple weeks. Right? Yep, new indicators are time and price. That's it. The time aspect of it is something that is very important that we will get to at some point. But again, I don't want to overload anybody right now. This is great. This is a great question. Once the model is complete, do you go to the next swing low to swing high? Absolutely. Okay? And this is, Gaj, where the inverse Mando model, and we've kind of dubbed it the odd NAM, comes into play. Okay? So let me see if I could cherry pick an example here. Let's see. We haven't had many of them because we've been bullish for so long. Actually, let's just go back to NASDAQ. We'll go back to the quote-unquote bear market. Okay? So at what point do we really know when this range is done? Did we reach all buy side or liquidity swing high targets? Yeah, if we did, then guess what? Anything above all-time highs, I got nothing for you. We've never been up there. There's no money resting up there for the algorithm to go and get. I have no idea when big money is going to start to sell off, right? That's as candid and to me as simple as I can possibly put it. I have no idea when this thing is going to stop on NASDAQ. Could we go to 25? Sure. Where are you getting that number? I don't know. I'm guessing. That's literally what it is. Anybody telling you that we're going to 600 SPY is just, yeah, I think that's where it's going. I think. There's no fabric behind that. We've never been there. There's no reason for the algorithm to drive to that point. We can use that as a specific target. Yet, we don't know when big money is going to pull their money off the table. When they tell us it's time, it's time. Okay? And how do we know it's time for us to go see discount? Bearish imbalance. Every single time that we've gone and seen discount in any of these price runs, back test it yourself, go look on any chart you want. Anytime we're about to go down to discount of the range, what do we see? Bearish imbalance. Okay. What do we see? Before we got down into discount right here. Okay, we got down into discount in August. Bearish imbalance. Every time. Every time we see discount, there's going to be a bearish imbalance. Bearish imbalance. Bearish imbalance. Look how price reacts to it. There it is. There was a few here, but our range was so quote unquote extended at this time. From 2020 to 2021, end of 21. And we ranged that range from 8,000 to 18. That's 10,000 points before you got any sign of retracement. Bearish imbalance kind of sold it to you, right? But That is essentially the odd nam. When you see that bearish imbalance, you could look to play a retracement back into it and then ultimately look for a discount. Not as big of a risk reward type win as what you can get with the Mando model, but still, so you're not sitting on your hands waiting for price to retrace down here, because this took a while. This bear market, quote unquote bear market, November down to, it was about a year of us steadily declining prior to getting to a discount, right? Do you want to just sit here and wait a year before pressing another trade? Probably not. But it's just another thing that you can add to your toolbox as a way to identify a downside trade. That's the odd NAM model. That's another thing that we're going to get to in much more detail as we continue on here over the next couple months. If you look at our third, again, I'm just going to briefly go over these. Our London kill zone model, that's much more futures or index based. It's not so much the individual names, but it's something that you can use to look for a quick hit in the morning, right? It doesn't even have to be the morning, but it's a quick hit based on the London range that you're seeing in your futures data. That's another one that we can use. And the last being that unicorn model, which that one's going to be a little bit more confusing right now, so I'm not going to explain it because I didn't teach you guys anything about breakers yet, but that's coming. And those are the most powerful, in my opinion, the most powerful type of imbalance that we can really look towards. They don't always occur, but when they do, they bang. So let me come back over here and make sure. Everything else will mess you up once you learn time and price. Yeah, it's true. And I always say this, just to be fair, you know, just because you're here doesn't mean that you have to trade like any of us. You don't have to do that, you know. But if I can show you one thing that you can add into an existing model that separates you, that's fantastic. That's a win. But you'll notice that all of those people who come in here with their own model that trade off of whatever it is, moving averages, trend lines, whatever, when they, been here for a little bit, you'll notice that slowly but surely each one of those indicators start to fall off until your chart's looking like this with nothing. The two I have are time-based. New week open gap, something we'll get to, and then just it maps specific times on the chart that when I click that on, it'll show me the 9:30 open. Again, that's the time aspect of it. We will get to that. But in terms of overall price delivery, can't get much more simple than this. This is something that is repeatable. It's something you can go back on any chart and do this on. Just got to give it a little bit of time, a little bit of practice, and the more time and practice you put in, all that's going to do is expedite the process for you to feel good about doing this for yourself. And when you do, start to reap the benefits. LKZ, yeah. Let's see. Mostly we all trade differently off the same concepts. Yep, basically, right. And that's the beauty of it, because there's a lot of things that fall under this umbrella of like reading price, right? There's totally a lot of stuff. But at the end of the day, like I said, I led the whole thing off with this. You don't have to trade like me. You don't have to trade like KD. You don't have to trade like Sean. You don't have to trade like Ryan. You don't have to trade like Seeker. Go down the list. Cajun, Kyle, breaker model, right? Snaz. You all have different models, right? Now with that, what's the key takeaway to all of this? There might be one thing that sticks out to you. You might have heard me just talk about premium versus discount. That might be all you need. When we get into breakers, that's a big one, because a lot of people have literally just built their model off of breakers. I know Kyle trades off breakers quite a bit. That's I don't know if it's exclusively his thing. Yeah, no, Ibra, you're right. We all trade ICT, but there's just so many different ways to go about it. And really, for me, it took me a while to settle in, use one, which is my Mando model, right? But beyond that, I started to say, okay, well, I see that price loves to come to discount. There's got to be a way for me to identify this and capitalize on that discount retracement so I can play it both ways. And then I, through back testing, this one didn't take as long because it's something as simple as an imbalance showing you that price wants to go to discount. Then that's where the odd nam or the inverse model came from. The kill zone is a time aspect, and that one's really smooth too. take out a high or low of that London kill zone, look for the opposite side following an imbalance formation. Smooth, nothing too crazy. And then the unicorn you need to know what the breakers are, which we'll get to. That's just a patented setup. It's visual, but we will get to that. I don't want to throw it all at you at once, but you won't be a poor. You go 2 weeks of working normal times, and you go 2 weeks off where you're working overnight and stuff, and then you try to trade the overnight, and it's not always great. But anyways, that is all I have. So for anybody in here who has any questions based on anything that we talked about tonight, feel free to send it over. I'll happy to answer any of your questions. And to me, I take pride in being able to answer the questions that are asked. When you ask somebody a question and they don't know what the hell they're talking about, they don't even address the question. I'll always address your question because I feel like with my model, I know all the ins and outs. Everything that you could possibly ask me about it, I feel confident to give you an example and an explanation as to why something would work, why something would not work. All right. So this is a lot of hours at work. What I just showed you there, I wish it was an hour long when I was putting it together, but that takes a lot of time. Snaz, I have it recorded. Don't worry. I'll put it on YouTube and I'll send it. But that's all I got. So again, if you have any questions about anything here, if you're struggling, if you're 3 weeks in and you're like, shoot, man, I got to figure this out. I'm falling behind a little bit. Just shoot me a message. We'll get it sorted out. Don't stress it. And don't be so eager to push buttons. If it takes you a little bit of time before you feel good about it, that's probably going to save you some stop out money along the way. Just take your time, learn the concepts, and when you learn the concepts, you're going to see how trading becomes fun. But that's all I got. So yeah, they're coming. Our lives like these are coming back October 1. So I just want to get some of the newer people here to get in the mix a little bit, just have somewhat of an idea, just so when we do start rolling, they're not completely behind. So, but all right, I'll catch everybody later on. See you. beauty of all work. Once you see it, you can't unsee it. Never go back to the way you traded right now. All right, what's going on, everybody? Welcome back to another weekly prep stream. Happy Father's Day to all of the dads out there. I have a great dad, but unfortunately, he's one of those guys who just looks for alerts. He's not really looking to learn how to do this just yet. So I'm working on him. All right, I'm working on him. But for real, I know a lot of dads from X in the group. I really admirable, what you're doing to try and put forward a better life for your family and of course you. So happy Father's Day. But more importantly, we got a big birthday coming up on Tuesday. It is my birthday. I am turning the big 3-0 on Tuesday. So as an early birthday present, I would appreciate it if you all liked the stream, reposted, commented. It all goes a long way, and I appreciate any feedback. Unless it's some dumb feedback, don't even waste your time because I'll clap back at you. All right. Yeah, my dad definitely needs to see the call outs tab. You got that right. Yep. So, obviously, I did an emergency stream last week. We had a little bit of a hectic end of the week with all the stuff going on in the Middle East. But we'll dive into markets as a whole. We'll dive into even a little bit lower time frame than we typically would to head into this week. We'll check out our economic data for the week. We will look at some individual names that are requested on X or in the group. We will also answer some of the conceptual questions that you guys might have. And last but not least, we will go over our long or short question for this week. And I think I need to smack a couple of you guys because that was a layup. And a few of you guys who definitely should get it right got it wrong. So with all that being said, let's dive into our economic data, and from economic data we'll roll right into our bigger picture with indices. All right, so let me get to sharing. I had to use a different little software to play my intro, but we got it all set now. And if I sound tired, I am. I had a really busy weekend. I had a lot of baseball, had a lot of family interactions and all that good stuff. So let's do it. It should be here. Bang. All right, beautiful. So we'll look at indices, but first let's take a look at our economic data. So tomorrow we have Empire State Manufacturing Index, which personally I don't have any remembrance of anything too volatile coming out of that. It is labeled as an orange folder event, so mid tier. The red folder is what we're really worried about. The red folder will give you that volatility, that the stronger moves, I should say. Now, for some reason, my clock is a little bit up. I'm not really too sure why, but let me just do this one more time. Yeah, it's got to be at 8:30. It's always at 8:30. Okay, so we have retail sales on Tuesday. That's at 8:30 a.m. That is red folder. We have unemployment claims. That is on Wednesday at 8:30. Followed by, so we do have FOMC on Wednesday. Okay, good to know. And then, believe it or not, after FOMC, we're really not working with too much. Thursday is off. Okay, that's a bank holiday for Juneteenth. And then Friday, we got nothing red folder. Okay, so early in the week, we got a lot, and then we have an off day mixed in. I didn't know the market was closed this day, but apparently it is. So, okay, that's fine. All right, so let's get into it. Let's dive into the indices right now. And looking at the big picture here, we as always, we start wide and we then zoom in, right? I actually have probably two of the best topics of discussion for you guys this week. So this week is definitely a can't miss week. for the 2025 mentorship. One pertaining to a specific time frame surf model that I think is going to be really helpful for a lot of you. I've been back testing something for a while, and I feel good enough to share it now with a bunch of you guys. And then I have one just, I always say this, I don't like talking about trading psychology because I think a big part of it is just ultimately, kind of having an idea of what you're doing. And then from that point, then you could really start to hone in on psychology. But if you don't have a model in place, if you don't have a specific entry model, a specific take profit model, or a specific stop loss model, then I think talking about psychology is just kind of useless, because you're honestly just you're never going to be in the right frame of mind, because you're never going to really know what you're doing, and you're never really going to be in control of the situation. So but I think this one will be helpful. It's a little bit beyond trading, and I kind of went down a rabbit hole, but I think it'll be good, and I think you guys could benefit from hearing what I have to say in that call. So and actually, you know what, before I start, sorry, I know I'm kind of I promise I'm not stalling. I just saw this really good video from Roger Federer. Actually, he's if you don't know who he is, he's he was my GOAT for a long time until Djokovic took over. But this video is amazing. Just and I'll relate this to trading, but I think this is really something that could, when you look at it from this perspective, it could help. So hold on, ready?
Because perfection is impossible. In the 1,526 singles matches I played in my career, I won almost 80% of those matches. Now, I have a question for you. What percentage of points do you think I won in those matches? Only 54%. In other words, even top-ranked tennis players win barely more than half of the points they play. When you lose every second point on average, you learn not to dwell on every shot. You teach yourself to think, okay, I double faulted, it's only a point. Okay, I came to the net and I got passed again, it's only a point. Even a great shot, an overhead backhand smash that ends up on ESPN's top 10 playlist, that too is just a point. So here's why I'm telling you this. When you're playing a point, it has to be the most important thing in the world, and it is. But when it's behind you, it's behind you. This mindset is really crucial because it frees you to fully commit to the next point and the next point after that. Find something.
So, I mean, for anybody who's, looking to trade, for a long time and not just be a one-hit wonder, I mean, that in itself is monumental. Think about it, right? When you're in that trade, that is the most important thing to you at that time. But whether it goes good or whether it goes bad, now that's in the past, and it's time to look forward to the next one, right? And he talked about how, while he won 80% of his matches, in terms of points, he only won a little bit more than half, right? So it's about the grand scheme, right? And think about it in trading terms, right? If you only win 54% of your trades, that doesn't mean that you can't be uber profitable if you have the proper risk management in place, right? Think about it that way, right? As long as those points that he's technically losing are, kind of, all right, 4 in a row, give him the game type of scenario where he's not letting these kind of points add up at the wrong time, aka allowing trades to get out of hand, you put yourself in a really good position to be successful long term. So I don't know, I saw that video, I thought it was something that you could relate to trading, and especially for those of you who are looking to do this over a long period of time and not just be the one hit wonder, right? Everybody wants to make 10 grand tomorrow, but think about if you don't have that model, you don't have the skills in order to maintain it, that that could be gone the next day. So it is a process, it does take time, but it is an extremely valuable skill in my opinion. So anyways, let's get to the indices now. So from a monthly perspective, still with 2 weeks left to go, we are in the process of creating a monthly bullish imbalance. Okay, we have not formed a monthly bullish imbalance since January of 2024. Wow. So it has been a long time. Okay. And as you notice here, we actually did wick at some point during this month, probably off of the open, into a previous bearish volume imbalance and have respected it thus far. Creating this bullish imbalance to me would be pretty bullish moving forward for us, as we have had discounts from a quarterly perspective on both the S&P and on Dow. Okay. So are we in the stages here where we could actually over the next, or I shouldn't even say over the next couple of months, but, to finish out this year, really, are we in the process of getting that expansive type run, something like this, or maybe like this, where we're creating the imbalance to set us up for our next leg higher? That is a possibility. Now, if when we get to those all-time highs, I say this all the time when we're at this, point in history, but beyond all-time highs, we really don't have any more specific pools of liquidity to target, right? At that point, it's kind of like, all right, from here, when big money, when smart money decides it's time for a retracement, that's the time for retracement. And we kind of have to play a little bit of a reaction from that point. And you might say, Mander just said react, smack him. Yeah, I think anticipating is always better than reacting. But in a sense, really, I have to be reactive because I need that first imbalance in the opposite direction to form in order for me to buy that we're actually going to retrace at that point. It's not like we're sweeping liquidity and I can anticipate an imbalance forming. Beyond that all-time high, we don't have anything to work with. Okay, so that would be really the only time I'm ever reacting, I guess you could say, right? It's much more of an anticipation, but when we don't have pools of liquidity to target, we can't necessarily anticipate beyond those all-time highs. So, but that's currently where we're at with 2 weeks left in the month. This is a very good sign for bulls, in my opinion, as we continue on here from a weekly perspective. Okay. So last week, we had the contract roll. Gotcha. Okay, so these levels are going to be an absolute mess, so we'll do them together here, no problem. Okay, so you will notice from your high down to your low. Okay, so just for anybody, a lot of my charts, futures based, are going to look like a mess right now. The reason for that is because when contracts roll, if you hear that, if you see that on Twitter, what that means is the volume has surpassed the current June contract and it is now rolling into the September contract. That's all, right? So if you were to go up here and you type in just NQ, right? You're going to see numerous different contracts, right? You're going to see the June expiration, you're going to see the September expiration, December, and then even next year's, right? But what the takeaway from this is at a certain point, those contracts will be rolled into the next month. Okay, so the June expiration is going to become illiquid. No one's trading it anymore. They're trading the September contract instead. Okay, and when that happens, you tend to see some numbers jump, and it just messes up my chart because I use the continuous contract NQ1 exclamation. That is up to date with all these rolls and everything like that. So it gets a bit messy, but it's no problem. But anyways, last week we did reach over this final bearish imbalance, but ultimately closed back inside. Okay. If you did watch the emergency stream that I put out on Thursday night, you will notice that there was, really one takeaway, I guess one major takeaway. And the major takeaway was really on daily imbalance forms to the downside. I'm not looking bearish per se, but if there is to be a downside reaction, this seems like a pretty good spot for it. And I'm not talking like a downside reaction that's going to take out yearly lows or anything like that, but this is an untouched weekly bullish imbalance here, which it's 1,000 points away, but that could be something that could happen here. Now again, there's no daily imbalance form, so it's I don't want to jump the gun a little bit here, but I will say that if there were to be some sort of reaction, this seems like a pretty decent spot for it to happen. Now this would technically have to inverse, right? Previous resistance flip support, which again it has the potential to do so. So it's all just kind of unfortunately waiting for a daily to form, in my opinion. I mean really in either direction. I think that'll be a really clear sign as to what's to come moving forward here to close out June. But from the weekly, that's kind of what I'm looking at, right? Nothing suggesting lower just yet, but wouldn't be a terrible spot for it to happen, right? That's all. So now we move on to the daily, and again, we do not have a daily bearish imbalance. We did have a little bit of a chance, but the fact that we do have this type of movement here, it pretty much prevented that from happening. So while there are a ton of relative equal lows down here and a bunch of previously filled imbalances, discount of the range gets you to 20,892 with that 727, right? 727 would get you into that weekly imbalance as well, okay? But again, nothing suggesting it just yet. But now look at the precision. Really, it's kind of remarkable where you look at this imbalance that was formed all the way back in December, right? The move up prior to that February 17th downside. Look how perfect the candles bodies are respecting this imbalance here on a daily time frame. And then look at the next one that formed back here in February 20th. The bodies are just perfectly respecting it again. So, I mean, clearly there is something to this, right? I mean, these can't just be made up levels, right? Prices reacting to every single one. It's just, again, it's imbalances in prices seeking liquidity, and it's going to rebalance these imbalances when necessary. Okay. So that's kind of what I have for NASDAQ. I mean, really, I'm, obviously everybody wants all the answers, but unfortunately right now, if I go through any of the trading models that I trade off of, this really doesn't meet the criteria for any of them, okay? There's no imbalance down to suggest 50%, which would be my odd NAM. And in this current situation here, we are not discounted out of a bullish imbalance, then to anticipate a run for highs. So it doesn't meet the criteria for any of my higher time frame, like trading preferences, obviously. But when you go down to smaller time frames, of course, that can differ, right? If bullish order flow is starting to present itself, then I can be looking for longs. If bearish order flow begins to set up, then I can potentially look for this imbalance to form and ultimately get us down into discount. So stinks, but it's going to be more short dated trade for me, unfortunately, from a NASDAQ SPY overall market perspective. Okay. So, while we're at it, let's just do SPY as well. Here you'll see from a quarterly perspective, SPY tag discount, bullish imbalance, and so far so good. Manda model would complete at 6166 on ES. Okay, that's from a quarterly perspective. Now you come on down to a monthly perspective, and very similarly, we are in the process of creating a bullish imbalance, and even more bullish actually on SPY versus NASDAQ, because over the next 14 days, if we close exactly how we are, not only do we create a bullish imbalance, but we also create a balanced price range. Okay, what that is an imbalance through a previous bearish imbalance. You might say, Mando, there's a bearish level here. Why didn't we reject off of it? Well, think about it. When the first imbalance forms, what's kind of the expectation from that point? And this is the odd NAM model, one of the two models that we talk about and that I use to trade on a day-to-day basis. When we form that first imbalance, the expectation is that ultimately we're going to discount of that bullish price run from lows up to our high. We already got it, right? So not only did we melt a previously bearish level, but we also created a bullish one on top of that. That's pretty darn bullish if you ask me. Now, listen, we got 14 days. This could change, right? I don't want to be too much of a homer or anything like that, but you got 14 days to basically prevent yourself from going to 5773. That would prevent a monthly imbalance from forming. And if that happens, that's going to be a mess. And I bet you this summer will be miserable in terms of trading smaller time frame. So that would be ES. Similar situation over here on a weekly perspective. Again, my levels are going to be all messed up because we had the contract roll. So let's do it again. High down to your low. Okay, we have one more little weekly imbalance. And this, again, last week, if you go to last week's weekly prep, I think verbatim it was, don't really see any downside until we get to this weekly imbalance, and then we get into that weekly imbalance, fill it to the legit tick. Can't get much more perfect than that. And then, obviously we rejected, and we headed lower to close out the week. But again, to me, if there were to be some sort of retracement, this doesn't sound like, seem like a crazy spot for it to happen. But again, from a daily perspective, really nothing is implying that we got to go see discount. If we were to reject from this point, I would anticipate something like this, 5813. That is a weekly bullish imbalance here. in the form of a volume imbalance. You also have a little mini breaker here as well. Low, high, lower low, break up and through. We would anticipate the high of that sequence to act as a support. So you have kind of two layers of confluence at this specific point. All right. So I think that is all I have for the indices. Does anybody have any questions about any of that stuff about there with the indices? Because, even if you don't necessarily trade SPY or QQQ, I think it's a really good idea to have a decent idea as to what the draw on liquidity is from a higher time frame perspective on the indices, because that kind of gives you a compass in terms of like how you want to trade, how long you want to kind of give in terms of like contract strike price, all of that stuff. You kind of can get a ballpark idea while using that higher time frame to map and structure your ideas. All right. So, yes, we are on. I'm just seeing these messages. So, yeah, I'm just looking at these messages here. Yeah, we are on YouTube. We are on Rumble, and we are on X. I'm not just doing them on Rumble anymore. No. All right. So, all right. And I just saw Mamba's message. So let's do that. Okay. So there was a question from someone in the group. They, Father's Day. Usually I'd tell you to kick rocks, but because it's Father's Day, I'll give you a pass here. So the question was, would you mind going through the nice midday QQQ dump we had on Friday? I saw price work into a large bearish fair value gap on the 15-minute and took puts, which worked well, but on 0 DTE, I got out fast. Price ended dumping hard. Okay, so I know you're relatively new, but for anybody else in the group for a while, you probably know what my rebuttal to this is going to be. But yeah, when you trade 0 DTE, you're automatically adding a variable in that you do not have control over. Okay, so you're adding in the time variable. If you did not trade 0 DTEs, you'd probably be more open to allowing the trade to actually do what you had envisioned in the first place. Sure, you made fine money, which is great, but if you had more time on those contracts, I bet you would have let the whole trade play out and you probably would have made more money. But let's take a look at it. Okay, so from we'll do it from an hourly, and then if it warrants it, we'll go down even lower. But I'm pretty sure this was just an hourly setup that made a whole lot of sense. Okay, so you have a where are we? Here we go. Yep. All right. So inside of this setup here, okay, from an hourly perspective, let's just zoom in really quickly, and we still have relative equal lows just to keep it real. But let me clean this up again. It's going to be a mess because we have the contract roll. Apologies, but okay, so just so you guys are aware of like kind of where we're at right now. So obviously that Thursday night was the puker. We left perfect relative equal lows. Now I'm not so sure. I need to check this just to be fair, because I don't know if we have SMT at the lows. SMT would just mean that NASDAQ didn't take the lows while ES did. Let's just check for a sec. Yeah, we do have SMT. Okay, so we have SMT divergence at the lows, aka we have SPY taking out the low just by a little tick. No problem. This is a miscellaneous line, but there we go. And one more. I'll clean up the whole chart, don't worry. So SPY took out the lows while NASDAQ did not, but leaving relative equal lows is automatically going to be sus moving forward for me, just to be fair. But from where we currently stand, that move on Friday that had occurred, right? You left the relative equal lows Thursday, right? Again, another set of relative equal lows. We started to make some progress here, and then ultimately on Thursday we puked. Now for Friday, like end of day dump, that was the point in question. Okay, so just from an hourly perspective, right? Just think about it from these couple layers of confluence, right? First would be, okay, relative equal lows, sus, no problem. Next, you have an hourly bearish imbalance here. Okay, that would be in discount of your price run from your highs down to your low. Okay, so you got kind of two layers here. You got a discounted imbalance, but you also have a bearish breaker. Okay, high, low, higher high, break down and through, and we would anticipate the low of that sequence here to act as a resistance level moving forward. So you had a couple layers to that in terms of just overall confluence. Now, again, in terms of speed of the delivery, right? Like even where was it? Somebody had talked to me about this, or this is a couple weeks ago. But Tesla, remember Tesla like just tanked out of nowhere, allegedly, right? It was somewhere in this vicinity. Yeah, here it is. Okay. So Tesla had like really tanked, right? And somebody like brought it up and they were like, yeah, like, did you envision that? And again, it was in the weekly prep. I'm not going to say that it wasn't, but we did talk about this in weekly prep on how we would anticipate turtle soup with that imbalance and then ultimately running for lows. But here's the thing, you know, I'm I'll take credit for saying I think Tesla's going down. I ain't taking credit for saying the rate in which it went down. Okay. I think right off the bat, I think maybe if you talk in terms of like larger time scale, like, yeah, I think Tesla could go to X price, but to envision a move where it was like 50 points in one day, unfortunately, I wish I had the answer for you, but I don't think there really is an answer. Like, I don't think that there is yeah, we're going to go down 50 points today because the next pool of liquidity isn't for 50 points, right? That's not always necessarily the case, right? We very well could have just took out that low, hovered here for a little bit, took out another low, hovered here for a little bit. And you know what I mean? So it's like, no, I did not envision a 50-point move in one day. Did I envision it going down? Sure. But that was very similar to what we saw on NASDAQ over here because, again, it was a snappy move, but, did everything make sense in terms of the reaction to it? Yeah, sure. Right. So again, if you could take the variable of time out of the equation, right? That's why I think for me personally, I think it's like 1 million times easier to trade shares because you're not dealing with time. But even when I trade options, especially with individual names, not so much with SPY and QQQ, I usually do what you just did, where you take short dated trades, but I don't kick myself if I sell it a little too early because I didn't buy the time, right? But with individual names, I tend to, for the most part, buy too much time, which is no problem. I want to take time, that variable of time, out of the equation as best as I can. Okay. So that's just from an hourly. I mean, if we were to dive even deeper here, I mean, I'm sure there's more confluence, but again, I have to clean up these charts really quickly. Yeah, I mean, let's just zoom this even more. Okay. So again, you had your 15-minute range mapped. So hold on. And this part is going to answer another question. So I'm going to take a little bit more time to do this. Okay. Because somebody had asked me a question regarding like, okay, breaker forms, like how do I, remapping the range, right? Remapping the range off of breakers, right? So when a breaker does form, ultimately you want to take that price run through the breaker, because when breakers form, typically that is a reversal pattern. Like that will generate those large scale moves. Okay. So realistically, to create the breaker in this circumstance, right, you had the high or low, higher high, breakdown and through. We would anticipate this acting as a resistance level moving forward, right? That would be your breaker. It's here actually. Sorry. So I'll map it out for you guys, but here. Whoops. Okay, beautiful. Okay, now let me zoom in a little bit more. Sorry, it's just this is my like day trading chart. So let me draw this in blue. Breaker's blue. You see blue, it's a breaker. Okay. So high, low, higher, high. Ultimately, we break down and through. The expectation is that we now have a breaker, right? And look how price reversed. Okay. That's the idea behind that. Okay. So let's map our range from our high down to our low. Okay. So from this point, price does run up and complete odd nam. Where does it complete odd nam? After the first formation of the bullish imbalance. Again, all my models can be back tested and proven. This is no hocus pocus, magic, imaginary friend here. You can back test anything, because in every single price run that ever happens, it is going to have a Mando model or an odd nam. It's just every single price move that has ever happened in the history of this price action. It has to. There's literally no way that there isn't one. Okay. But anyways, you have your rundown through lows to create the breaker. Price ultimately creates the first imbalance here, and then you get your trend up towards discount of this bearish price run. Okay. Now here, there was a little bit of a staple to kind of imply that we were ultimately going to go higher, right? And here it is. What is that? Low, high, lower low, break up and through. We would anticipate the high of that sequence to act as a support level moving forward. This is a bullish breaker. So let me label these. Whoops. I got to do caps. I like doing caps. I think it's a lot clearer to see. Okay, so that would be a bearish breaker, and this would be a bullish breaker. Don't you just love it when, you hear about stuff and it actually works? Holy crap. Okay. So anyways, there's your break up and through. Here's your retracement back into the bullish imbalance. And even if you wanted to trade it like from this is a 5-minute chart, but if you were to trade this from a 5-minute perspective, okay, what was the run to create the breaker from low up to your high? Here's your discount retracement, not only into the bullish breaker, but also into this 5-minute bullish imbalance. And beyond this 5-minute bullish imbalance, what else do you have? Turtle soup. We swept liquidity in the opposing direction of your overarching trend, right? Took out all those little lows inside of here. Goodbye. A plus high probability setup. Okay. And then if you were just wondering, because like I said before, every single price run that has ever occurred in the history of ever has a Mando model associated with it. So here it is again, low up to your high. Here's your discount retracement into a bullish imbalance. Left behind relative equal highs for one more dunk lower into that bullish imbalance for your next run. Okay. So again, every price run in the history of the universe. Okay. So here's just another layer to this one, right? So you had that bearish breaker, you have this bearish imbalance in discount of that bearish price run. It all makes sense. Okay. So unfortunately, right, if you were to trade something like this, you would really have to anticipate that we were going to get in here and ultimately reject, but it's fine. You could play that. Sometimes the range is just a little too big. Okay. And in this situation, the range would be a little big for me. So what I would do from this point is go into either a smaller time frame, or B, allow bearish order flow to present itself again to take the downside trade, right? So in this instance, right, you shift structure here from a 5-minute perspective with that price run. Price retraces back up into this bearish breaker again, recurring theme of the night, I guess, right? Okay. High, low, higher high, break down and through. We would anticipate the low of that sequence to act as a resistance level moving forward. Bearish breaker. There's your rejection from that point. But really, to me, what I would be trading, and it might not be as lucrative, but to me, this is just ultra safe, is the creation of the next bearish imbalance, price retracing back into it, and then ultimately looking for that run down through lows, which is here. Okay. And again, if you had time, you allow that to take place, because that took place over, let's see, from the 5-minute. 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, about 90 minutes, say. So an hour and a half. If you're trading 0 DTEs and you take a strike that's way out of the money, you're probably not going to let that play out. All right. So that would be the just the breakdown. I know you had to go, but I think that also plays into the format of the new breaker terminology and all that. All right. So that would be indices. That would be all that good stuff. So let me just see if you had another. You're very welcome. No, I'm not from the Bay. No, not from the Bay. Do you use adjust for contract changes on every time frame? Nah, I don't. Nope. Nah, I use the continuous contract. Eventually, it will become more liquid. It's just obviously with the rollover right now, it's. But ideally, I guess we could take a look at it here from the daily, because we are in kind of a pretty important spot. So hold on, let's see. Yeah, so even with that on it, it really doesn't make any difference, because we're not forming an imbalance here. So, and then again, it's the bearish imbalance right here. You see how the numbers are just the same delivery, it's just the numbers are a little off. That's all. So that is NASDAQ. That is an explanation on some price action from Friday. That is, a discussion, because that was one of the questions coming in tonight from Shiv, the plug. about creating or mapping ranges following the formation of breakers. Okay, so that is indices. All right, we're pushing 2K here on X, so appreciate all of the likes, comments, shares. Remember, it's my birthday on Tuesday. Don't be that guy. All right, or I'm not doing this anymore. Kind of kidding, but not really. All right, so that is that. Now let's get into the fun part for me, because this is something that I challenge everybody to do, because I think you are going to become a better trader if you do this. And this is the long short. Okay, so the long short question for this week is right here. All right, and I do this every week. I'm not trying to trick you. This is just, I don't even want to say pattern recognition, but it is a little bit of a practice in terms of identifying current structure, identifying the draw on liquidity, identifying imbalances that may or may not be in discount of that particular range. And like I said before, some of you guys, you might need a little slap for this, but to me, this was a pretty easy one. So let's go over this right now. And again, I challenge you to actually answer this, put it in writing, and see where you're at, right? Because I only think this is going to be better, right? And also, I wouldn't be able to do these every week if these price runs didn't happen all of the time, right? There are sometimes I want to maneuver different time frames and all of that stuff, but these are patterns that are very recurring in price delivery. So anyways, the focal point here right off the bat, because I think, step one is to identify the draw on liquidity. And I think in order to get to that point, how do you really get there? Like, how do I know which direction we're going, right? We can identify what the current structure of the market is, right? What are we bullish? Are we bearish, right? I say market structure. You can use trend. It's interchangeable, but a lot of people use the word trend and they don't even know how to define one, okay? So when higher time frame highs and lows are swept, that will be the distinguishing factor in terms of creating our trend, okay? So when you look from this perspective, right off the bat, I want to look for my pools of liquidity, okay? So liquidity pool numero uno is here, okay? Number two, Gulp, relative equal lows, okay? Is this price run bullish or bearish? We took out numerous sets of lows with what price run? From our, right? And even here, high, down to your low. Okay, here's your discount retracement. I bet you if we were to go into a smaller time frame, there is an imbalance here. And or ES took the high and NASDAQ didn't. SMT. Okay, there's no made up stuff here. There's your rundown through lows. That would be completion number one of the Mando model. Here would be your next from your high down to your low. Now, again, you're going to say, oh, this is gross. This is gross PA. Yeah, it was. We were talking about this while it was happening. It was terrible. Okay. You got the discount. You have smaller time frame imbalances. I'm sure of it, for a flush down through lows. And now you have an established range. Right. Okay. So we're going from our high down to our low. Oh, whoops, I almost gave away the answer. Okay, so we have a bearish price run, okay? We have relative equal lows. Do we have a discounted imbalance in which we can use as a structural guide for our idea? Yes, we do. We have a bearish imbalance in discount of this bearish price run, okay? Boom, and I don't know if we reached into this one, but we have one more above, okay? This is where you would hear me say I want the breakaway. The breakaway is what is going to form a higher time frame imbalance, okay? Like an hourly or something like that, okay? You can go back to Wednesday and see if there were any hourly imbalances formed as a result of this. So when you get into a discounted bearish imbalance, the expectation from this point is that ultimately we are going to get into the imbalance and get out of the imbalance and ultimately start to look for liquidity lower to complete the Mando model at 713, okay? Now you can zoom out and bloop. Okay. So that would be a picture perfect bearish Mando model for the win. Okay. So if you got this correct, congratulations. Good job. If you didn't, get to work a little bit. Okay. These relative equal lows are sticking out like a sore thumb. You have the bearish imbalance here as well. And from the given point on the chart where I gave you this, does this look like a high probability long to you? Not really, no. Okay. There's not much going on there. So that would be a short for a downside W. Okay. And again, this is the model that I show you guys every single week that we're here on live, because it happens every single week. All right. So that is indices. Okay. That is our long or short question. Now, does anybody have any questions regarding that? And if you don't, that is all right, because it is time to dive in. So let's see. Let's see what our friends on X had asked. Okay, so I covered Shiv's question. I covered the Mamba's question. So now let's see. Okay. Oh, wow. Okay, we actually don't have many questions. Great, because we were running a little long there. All right. So, all right. The first one we'll look at is CRML. Let's look at CRML. Okay, this is a penny stock. When it comes to penny stocks, I'm out. I don't like to talk about them. Because to me, the necessary liquidity to move something like this is outside of the marketplace currently. Okay. And when that happens, I have no interest. Okay. Because I don't feel like sitting in something for 10 years to get it to move. But from a price action perspective, let's just forget about the price. We'll talk about the actual setup. So we're at all-time lows, or just off of all-time lows from a quarterly perspective, and nothing from a quarterly is telling us that we need to go see discount of this range just yet. Okay. CRML. Speedster's a good guy. That's why I'm doing this. But Speedster, he's been following me for a while. He comments a lot, so I'll do his. We're putting in relative equal lows here on the monthly. Not really ideal, to be honest with you. But and we also have a monthly bearish imbalance overhead as well. So just right off the bat, this is really not something that I want to be looking at, to be honest. But we'll continue just for the I guess just breakdown. But now looking at it from this perspective, okay, ultimately, again, each one of these candles can, of course, be justified. And ultimately, we reject moving lower, taking out these relative equal lows to set you up for another new low. Okay. So from this point, we are now looking at a pretty large range, okay, from about $9 down to your lows at 1, where we currently stand here on a weekly perspective is it's not the worst, but it's not the best, okay, because you did have an imbalance here, and while technically you did not blow this trade just yet, taking out the low of the candle that created the imbalance fails it, I don't think things are looking too great here, okay? The contingent would be really to create a weekly imbalance. If you create a weekly imbalance, then to me, it looks like a run to 281 looks solid. But from a weekly, nothing's really showing that. So CRML. And now we come from a daily. I would need this daily to form, meaning as long as tomorrow you don't go see 164, you create a daily imbalance. If that's the case, now you have structure for the idea. And ultimately, you do have relative equal highs to about 281. Beyond 281, I look left and I don't see too much, okay? I do see buy side here at 398. So, I mean, it's okay for a short-term idea, short-dated but the higher time frame really doesn't look too good on this. So I would be out on this. Okay. This one's getting all the rage. I was going to do a write-up on this one today, but I decided not to because I didn't feel like doing it, basically. But so here's Oscar from a quarterly perspective, OSCR. And this one I think looks actually really good. All right, so let me explain. From a quarterly perspective, you're inside a quarterly imbalance, and you might see I have a line here. That would be like the most ideal location, I think, if I can get it there. I'm not so sure I can, but I would personally love it. But you don't always get what you want. All right. but here is what I'm looking at in terms of Oscar. Okay, so we most recently, over the 12 months, rejected out of that bearish quarterly imbalance here. Our bearish price run from the, I guess, initiation of this stock, because, I know 2021, but in the grand scheme of things, like, there's really not all that much data in the world on this name in terms of price delivery from a quarterly perspective. So where we are right now, we are technically sandwiched, bearish imbalance, bullish imbalance. I like the response out of this bullish imbalance thus far, but is this enough? Could we see 1049? Let's see. Okay, let's come to the monthly here. Now I look from a monthly perspective and I say to myself, okay, this actually looks pretty good here. We got the discount, we got the bullish imbalance, all good, all great. I look left, we don't have any imbalances overhead. All right, it's not looking bad. Now I come to the weekly. And then from the weekly, here's where, I kind of give myself a little hope that I'm actually going to get an opportunity at 1049. I look at this and I say to myself, okay, well, ultimately we banged around inside this bearish breaker multiple times, rejecting each time. And then in the most recent price run, okay, you had a sandwich and the bearish imbalance last week. Okay. If you go back to May 19th, if you just go back to that weekly prep, I bet you everything I said in that is exactly what happened. I actually don't bet you. I know for a fact. Go back and look if you don't want to take my word for it. I actually encourage you to go back and look at it because that is a work of art. What I said was, like I say all the time, all right, I want to see if this imbalance forms. If this imbalance forms a bearish one, then my expectation would be ultimately price gets into it and then price can reject lower and maybe I see this, okay? So yeah, so I have a little bit of hope that I can get this. This is like the last chance imbalance. I like these because you'll know relatively quick whether you're going to be right or wrong. And I think that's a good position to be in so that you're not sitting in something for like 7 months and then it's like, oh, my trade setup blew up. I just wasted 7 months sitting inside of this. So, so ultimately, while I think from a large scale, this looks really good, I'm holding out some hope I can get a chance here. I think that would be awesome. All right. So that is Oscar. All right. So let's see something here. I want to get a drink of water here, but I'm gonna look through and see if there's anything else we got to talk about, and if not, we out. All right. So let's just do a couple of the big names. How's that? We'll do Tesla. We'll do NVIDIA, and we will do Tesla. I think we need to talk about because somebody told me if you know, you know. You don't know. You don't know anything. You don't know anything, buddy. All right. You think you do, but you don't. Okay. So here's Tesla. Okay. Let's do this for the month or quarterly. Sorry. Okay. Even if I tell you, you're not gonna know. You're not gonna know. All right. So here's Tesla's quarterly. I like this quarterly imbalance. That would be amazing, but 212 pretty far away. A retracement to 212 that would probably suggest a much deeper market retracement, and I'm not so sure that happens. But if that left open, so be it. Okay, we took out previous quarter low, and then since that point we ran higher. Now here's the thing, and this is something where just to be honest, I've never really come into contact with this, and that's why I haven't. Been echoing it as much, but we're kind of using this as a case study moving forward for the group. When Tesla did put in this low, in that overnight session, like the Robinhood hours, it actually did get into here, but it's not painting on TradingView. So we're kind of using this as the case study. Is that overnight session worth anything? Like, is it worth noting that we hit that specific target that we had, which was 212? Is it worth it knowing that it hit in the overnight and ultimately we didn't get it in these TradingView trading hours? It was just that overnight Robinhood action. So again, just using that as a case study, so we'll have answers at some point, but we did take our previous quarters low, and then we started to move higher. So now into the monthly. Again, it's going to be very similar. Okay, we ran into a monthly bearish imbalance for the first time, and this typically happens where you get pretty sharp rejections off that point. Okay, example hither. Okay, bearish imbalance, price gets into it. We were at one point we were above this bearish imbalance 229 by like $50, and then we snapped to close the monthly back inside it. Okay, just to show you like the the way I put it is like a monthly perspective. Like that's a whole lot of orders that we got to get through to rebalance this range. Okay, and that's kind of what you see right now. We're kind of sticky. All right, so here's your Tesla weekly. All right, so we did get into this should be a bullish volume imbalance. Okay, bullish volume imbalance, very nice. Price gets into it, and so far so good. Here's the thing: we did create a weekly bearish imbalance last week. Okay, so we talked about it in last week's weekly prep, but this imbalance here, we said, all right, is Tesla going to do the impossible and close what would be this newly formed imbalance? Okay. So I'm not so sure that we're going to get in here and reject. I think if anything, it could be more of a speed bump because we've already gotten that discount. For example, see SPY here, right? We already got into discount. So that imbalance from a monthly perspective, are we anticipating much out of it? Maybe just a speed bump. Okay, that's it. So I think that's probably likely. You still have more bearish levels overhead, but so I mean, I don't think Tesla's completely out of the woods, and I don't know how much fun of a trade it's going to actually be next week. But yeah, we have a showtime level for sure. It's about 10 points, 345 to 335. So I think price will get into here, and then from there it's showtime. I'm kind of hands off until we make or break that level moving forward. All right, so that is Tesla. Let's look at NVIDIA next. So let's go here. All right, so NVIDIA also in the process of creating a bullish monthly imbalance. You got 14 days left. As long as you don't see 115, you create the monthly imbalance, which is very bullish. We did sweep this low, and then, here's where I obviously wanted it, never got it. Oh, well. But yeah, I think that's kind of dead and gone, but, it ain't over yet, folks. But here's a bullish imbalance on the monthly forming right now. So let's come over to the weekly. Okay, so you will notice that ultimately, following the sweep of liquidity last week, we closed back inside. That would be a bearish turtle soup scenario. Okay, so from this point, right, very similar to NASDAQ. It actually looks exactly like NASDAQ, believe it or not. Okay, you have a bullish imbalance that had formed from a weekly perspective here, aka showtime. This is the final bullish imbalance inside of this price run. And you also have a breaker here, low, high, lower low, break up and through. So you got a couple layers of confluence there. Now, again, that's contingent on NASDAQ doing the job and retracing as well. Again, nothing's really suggesting it just yet, but if there were to be a place for it to happen, it does make some sense for it to happen inside of that weekly bearish level here, aka showtime. Oh, I deleted my levels. Whoops. All right, so NVIDIA in a very similar spot. All right, let's look at Apple, and then we'll see chat, and then I'm gonna call it quits. Yeah. So if you're typing in the Discord, I don't want to get into this habit, so we're not gonna do this. If you're typing it in the Discord while I'm doing the live stream, just put it in the live chat because I'm clicking all over the place. But all right, so here's Apple. So you have a massive range on Apple dating back to the COVID lows up to your high. You did retrace into a bullish imbalance here on the monthly time frame, and you're really not seeing too much urgency to move higher. Apple, to me, really doesn't look like one of the better names, to be honest. And he actually left some relative equal lows here as well. I rarely ever trade Apple. I'm not really a huge fan of trading Apple anyways. And then here, just kind of confirmation of bearish order flow with the rejection of that bearish imbalance here on the weekly time frame. You got multiple sets of lows. You do have a previously bearish imbalance flipped bullish here. That's at like 188. And then you got relative equal highs up here. So to me, I would say it's more likely that we go see here first before running back to like 214. But I really don't like Apple at all. So besides the iPhone, like the actual iPhone, I think it's pretty good. So yeah, I think that's it. So let me just scroll through really quickly and see, and if not, we'll get out of here. So yeah, definitely no, not from the Bay. No. All right, so yeah, that's gonna be it for me. So this week, I will be doing a live call. Actually, I don't know if I want to do a live like and just play the recording while we're on live, or if I just redo it basically. I could do that. Monday, Tuesday, I'm out. We'll do live trading for a little bit in the morning, but then I'm done. Because again, it's my birthday, so it's a pretty big birthday too. So you gotta like the stream, you gotta share it. And then we'll be back Wednesday. We'll do live trading, and then Wednesday night we'll do the second call for the week, and then Thursday live trading. Friday. Oh no, Thursday. Shoot, the market's closed. Yeah, so Thursday maybe I'll do like an EDU seminar. If you're listening right now and you would want to do an EDU seminar, comment it under this this weekly prep. I'll do it for everybody too. Maybe we'll see actually. And then Friday. There's no data, so I don't know if I want to do Friday instead. Yeah, we'll just do something else on Thursday instead. How's that? Yeah, so that is what we got for the week. So with all that being said, good luck this week. I hope everybody does well. And remember, continue to look at the big picture. Win the battles to ultimately win the war. Don't just go for the war win in one shot. So good luck to everybody this week. We'll talk soon. When you're ready to stop playing the lottery and actually learn how to do this, come on over to Galaxy Trading for thousands of hours of educational content, weekly class sessions, live trading, and a kick-ass group of traders. The best part? Actual timestamps and receipts of our work. Once you see it, you can't unsee it, and you'll never go back to the way you're trading right now. See you soon.